Welcome to StokTok's deep dive into PDD Holdings Incorporated. PDD Holdings is a Chinese e-commerce and social commerce platform that connects consumers with small merchants and brands, generating revenue through marketing services and transaction fees. As of May 8th, the stock is trading at $98.78. Over the past 52 weeks, the stock has ranged from $95.24 on the low end to $139.41 on the high end. The Relative Strength Index, or RSI, sits at 47, indicating a neutral technical position. The 50-day moving average is at $100.73, while the 200-day moving average sits higher at $114.65. Let's work through the fundamentals, scene by scene, starting with a quick business overview. PDD Holdings operates as a marketplace and social commerce ecosystem, connecting sellers with buyers across Tier 2 and Tier 3 cities in China. The company monetizes this network through advertising, transaction fees, and value-added services. The competitive moat here rests on network effects. The more buyers on the platform, the more valuable it becomes to sellers, and vice versa, combined with deep penetration in lower-tier markets where the company has become the go-to destination. According to our StokTok scoring model, PDD earns an 82 out of 100 overall score. Breaking that down, valuation scores 17 out of 20, financial health scores 17 out of 20, profitability scores a perfect 20 out of 20, growth scores 20 out of 20, but smart money positioning scores only 8 out of 20. That divergence is worth noting. Strong fundamentals, but institutional conviction is more muted. Now, valuation. The question every investor has to answer: are you paying the right price? PDD trades at a price-to-earnings multiple of 10.32 times trailing 12-month earnings. That is a substantial discount to the broader market and even to many of its peers in retail and e-commerce. The forward price-to-earnings ratio, based on consensus analyst estimates for the coming 12 months, is even more attractive at 8.07 times. The price-to-earnings-to-growth ratio, or PEG, stands at 0.00, which reflects the disconnect between how cheaply the market is valuing this company relative to its earnings power. Enterprise value divided by EBITDA, a common measure used by acquisition-minded investors, is 4.63 times. These are all signals of a deeply discounted valuation. In our view, the market is not giving credit to the quality and consistency of PDD's profitability. From a fair value perspective, our discounted cash flow model suggests the stock is trading at parity to intrinsic value, with 0% margin of safety. That means the market price and our fundamental estimate align. Wall Street analysts have a consensus mean price target of $143, with targets ranging from $111 on the low end to $207 on the high end. 33 analysts cover this name, creating a reasonable sample size for that consensus. The latest earnings results, reported approximately 49 weeks prior to this analysis, showed a revenue figure of $123.91 billion, growing 14.4% year-over-year. That represented a miss relative to consensus estimates, and earnings per share came in at $11.41, significantly below the consensus expectation of $18.96. Despite that miss, the core profitability of the business remained intact, with operating income of $26.2 billion and net income of $23.02 billion. Market sentiment around PDD leans bullish, with investors highlighting the attractive valuation alongside strong profitability metrics. The setup suggests the market is positioning this as a compelling buying opportunity for those seeking undervalued companies with solid earnings potential. Moving to financial strength, how solid is the foundation? We look at two diagnostic frameworks here. The Piotroski F-score is a 9-point health checklist that examines profitability, leverage, liquidity, and operational efficiency. PDD's F-score is 6 out of 9. That score is moderate. It indicates financial health, but not all signals are flashing green. The Altman Z score, a predictive model developed to identify bankruptcy risk, comes in at 5.27 for PDD. Scores above 2.99 are considered safe zone, and PDD comfortably exceeds that threshold. So from a solvency perspective, there is no distress signal here. On the debt side, PDD maintains a fortress balance sheet. Cash-to-debt ratio stands at 78.51, an exceptionally strong position, meaning the company has roughly $78 of cash for every $1 of debt. Debt-to-equity ratio is 0.01, which is effectively no financial leverage at all. The current ratio, measuring short-term liquidity, is 2.43, well above the 1.0 threshold that signals comfortable working capital management. Interest coverage ratio is not applicable here because the company carries minimal debt, so interest expense is negligible. In our view, the balance sheet strength is a major asset. Management has demonstrated capital discipline. With zero dividend payouts, all cash generation is retained for growth and strategic optionality. The constraint here is not financial weakness, but rather the moderate F-score, which suggests some operational metrics could be stronger. Overall, the financial foundation is solid and safe. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, is 62.19%. For context, that means for every dollar of capital deployed in the business, the company generates 62 cents of annual economic profit. That is exceptional. To put this in perspective, most large-cap companies generate returns in the 12 to 18% range. PDD's return on invested capital sits in the top percentile of global business quality. Gross margin, the percentage of revenue left after cost of goods sold, is 56.28%. This reflects the high-margin nature of advertising and transaction fee-based business models. Operating margin, which measures what percentage of revenue becomes operating profit, is 21.57%. That means roughly $1 in $5 of revenue flows through to operating profit. Net margin, the ultimate measure of how much of each revenue dollar becomes profit, is 22.66%. These margins are exemplary for a platform business at scale. Free cash flow margin, the percentage of revenue that converts to actual cash available to shareholders, is 24.79%. This is particularly important because it shows the business not only reports strong accounting profits, but actually converts those profits into cash. Return on equity, measuring how efficiently management deploys shareholder capital, is 27.13%. Return on assets, measuring overall asset efficiency, is 17.25%. These returns are indicative of a best-in-class business model. The earnings miss noted in the latest quarterly results did not signal a profitability crisis. Operating and net income remained healthy absolute figures. In our view, PDD's profitability profile is one of the strongest attributes in the equity story. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years is 48.5%. Over a 5-year horizon, the compound annual growth rate is 44.4%. These are robust expansion rates for a company that is now generating revenues in the 100 billion plus range annually. When a business can maintain compounding growth in the 40% range at that scale, it indicates either strong underlying demand, market share gains, or both. Book value growth, the expansion of shareholder equity on a per-share basis, is 47.7% over the trailing 3 years. This aligns closely with revenue growth, suggesting earnings growth is keeping pace. Notably, PDD pays zero dividend, so all capital is retained and reinvested in the business. This is typical of growth stage companies and reflects management's philosophy of compounding value rather than distributing it to shareholders today. The latest quarterly revenue figure of $123.91 billion represented 14.4% year-over-year growth. At first glance, that appears as a deceleration from the multi-year average. However, the data point is approximately 49 weeks old, so current period growth rates may have shifted. The broad setup suggests the business is still expanding meaningfully. though perhaps at a moderating rate as it laps higher bases and encounters market saturation in certain segments. In our view, the growth rate is solid without being spectacular, which is appropriate for a company at this stage of maturity and scale. Now let's talk smart money. What institutional capital is actually doing with this name? According to Dataroma, the research firm that tracks top-tier portfolio managers, 14 prominent gurus currently hold PDD in their portfolios. Among the largest holders, Norbert Liu of Punch Card Management has allocated 15.64% of his portfolio to PDD with no recent change in position size. Lai Lu of Himalaya Capital Management holds 14.64% of his fund in PDD, also unchanged. Duan Yangping of H&H International Investment holds 7.48% and recently added 34.55% to the position, signaling conviction and a bullish outlook. David Tepper of Appaloosa Management holds a smaller 2.94% allocation, but reduced it by 1.39%, a slight trimming. Sarah Ketterer of Causeway Capital Management holds 0.58% and recently added 19.89%, indicating a new or expanding interest in the name. The breadth of guru ownership is meaningful, but what is more telling is the specific direction of recent trades. 3 gurus added to positions in the most recent period, 1 trimmed slightly, and 1 remained unchanged. That suggests cautious optimism among elite managers, not euphoria or conviction selling. Separately, only 3.5% of the 13F institutional filers tracked by our database are net buyers of PDD, compared to a 50% threshold that would signal broad institutional bullishness. That metric is below our comfort level for strong consensus buying. Insider ownership stands at 0%. Management owns virtually no personal stake in the company. Insider transactions over the last 3 months show 0 buys and 2 sells, a signal of minimal insider confidence in current valuations. The divergence is notable. Top external investors are selectively adding, but insiders are not putting their own capital to work. In our view, this suggests institutional capital recognizes value, but lacks the kind of catalytic conviction that would drive outsized returns. And finally, the verdict. Let's bring it all together. Valuation. The stock trades at a substantial discount to historical levels and consensus estimates, with an 8 times forward PE multiple and 0% margin of safety to our fair value estimate. Financial strength. The balance sheet is fortress-like, with minimal leverage, strong liquidity, and an Altman Z score well into the safe zone, though the Piotroski F score of 6 out of 9 suggests room for operational improvement. Profitability. This is a best-in-class business, with a 62% return on invested capital, 22% net margins, and 24% free cash flow conversion, exceptional metrics for any business model. Growth. The company is expanding at 40 to 44% annually on a 3- and 5-year basis, though recent quarters show moderation to 14% as the base grows larger. Smart money. Top-tier gurus hold meaningful positions and are selectively adding, but insider ownership is 0 and insiders are not buying, suggesting external capital sees value that management is not yet endorsing with personal capital. The latest earnings results, reported approximately 49 weeks prior, showed an earnings miss but maintained solid core profitability, indicating the valuation discount may be partially unjustified given the underlying business quality. Bringing these threads together, in our view, PDD presents a thesis centered on a deeply discounted valuation applied to a high-quality, high-return business that is still growing substantially. The risk is that growth rates continue to moderate, and the market reassigns multiples downward even from current depressed levels. The opportunity is that consensus eventually recognizes the quality at a discount dynamic, and the stock re-rates toward historical or peer-relative multiples. This is not a story about explosive growth or a comeback narrative. It is a story about a profitable, cash-generative business trading at a material discount to intrinsic value. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That is the deep dive on PDD Holdings Incorporated. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.